So what is the state of the union? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, everyone. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know, I do appreciate it. Well, from debt to the economy to the markets, how is everything looking? Financial advisor Patrick Mueller is here to weigh in. Patrick has also written a book titled Dare to Succeed. Patrick, welcome to Prudent Money.
Great to be with you, Bob.
You know, what I thought we would do today is just kind of talk about everything that's going on and get some opinions flowing and see if we can solve the world's problems.
What do you think? Good. I mean, it sounds right up our alley, right?
So, look, we're rounding the corner, heading to November. Let's think back to January of this year. If you were told how the market is doing and the economy is holding up, and you were told that at the first of the year, what would you believe? Would you believe it, or thought the forecast was way off?
That's a good question. I knew we were going to be in for a rocky ride this year. It was going to be like a 12-round boxing match, and I think we were still going to be standing at the end of the year. And we had the first Trump administration where the markets did really good. It responded very favorably, and you knew there was going to be a lot of pro-business moves that were going to be happening, but I thought it was going to be choppy. But if I had thought that it was going to be down 20% in April and then up over 15% now, I wouldn't have thought that.
Well, speaking of the market, tell me how you feel about this. I mean, I'm with the opinion that we're back to that bubble environment again and getting more out of balance as the days go by. Mm-hmm. How do you think the market ends up this year, and then any thoughts about 2026?
I think the markets this year, we're due for a little bit of a pullback. I mean, the market's just been on such a tear, and you're right. Things are so overvalued, I think, at the moment. So I think we're going to be in for a downturn, and that might come to pass when we start seeing some of the price increases from the tariffs, because we're going to see some of that. These corporations can't eat, they don't have enough profit margins to eat into a lot of these big tariffs. So we're going to start seeing something from that. So maybe when we start seeing those numbers come out, I'm not sure exactly what the catalyst is going to be, but I think we're going to be in for a pullback. So I don't know if we're going to end up flat with where we're at now throughout the end of the year. If it were me guessing, I would say, we could have a pullback of about 10% by the end of the year. And long term, I mean, there's so many good things that are happening, Bob, I think, with us being able to start selling into other countries. So when it comes to Europe and India and China, that long term, I think that's just really good for U.S. manufacturing to be shipping into all these countries. So I think that's going to be really good for the country long term.
I was looking through your notes, and you had something interesting in there about the S&P 500, and it made me wonder if the S&P 500 as it is today with so much tech influence and AI influence that investors who are invested in that realize maybe a little bit of an extra premium of risk that they're taking.
Well, it's nuts, because you have like NVIDIA right now that is, I want to say it was the last article I read, it was 37% of, and tech companies, the top 7 tech companies represent 37% of the total growth of the S&P, which is, it's so overweighted and so skewed right now. NVIDIA is bigger than 5 different market sectors. So it's got such a huge influence. So if people are overweighted in that, when we say big pullback, they might think they're diversified, but they might not be that diversified, especially if you own a mutual fund. Like somebody could own a bunch of different mutual funds, but what do those mutual fund companies own? What one mutual fund company likes, typically all of them like it, right? They typically all own the same stuff, like the Mag 7 or, NVIDIA and AMD and companies like that. So people are probably way overweighted in that stuff, and they don't even realize it. So if we start seeing a big downturn in the tech sector, they could be in for a wild ride.
Now, do you see any comparisons at all to the dot-com bubble back in the late 90s?
I think there's a lot of comparisons to it, but one of the things that's a little bit different, back in the dot-com bubble, you didn't see, there was a ton of companies that had no profits whatsoever. And it's like,
Yes.
what is going on here? The market's going to the moon. These companies don't have any profits. It's like, what is happening? So you knew something was in store, but now we've got these tech companies. They've got good earnings, right, that are coming in. So that's a big difference. But I think a lot of people feel it. I definitely feel it, that I feel like we're in a bubble, and we've been way overdue for a market correction. It's hard to believe that 2018, right? We're 16, 17 years out from the crash we had back in '08, and we really haven't seen a big downturn since then. So we're overdue, Bob, I think.
You know what's interesting to me about that you bring that up, Patrick, is that so many investors have really forgotten the lessons that to be learned and instilled in an investor's lifetime from what happened in '08. And or just as if it didn't happen, but it's still, I don't know about you, I mean, managing money through it, it's pretty fresh on my mind.
Yeah, and it's something that I preach on a daily basis, because most of our clients are retired or within maybe 5-10 years of retiring. So we talk about a lot about how you have to have so much money of your portfolio, have it safe and protected from market losses, because as you get closer to retiring, it's so important, because you need this money to live off of. So we use the rule of 100, where take your age, and that should be the percentage of your savings should be safe and protected from market losses. So if somebody's 50 years old, then 50% should be protected, and 50% it's okay to have risk in the market. So somebody who's 65 should have 65% protected, because now you don't have time to go through a big downturn, because there were so many people that I've met that they're getting ready to retire, and the tech bubble burst, or 2008 happens, and the markets go down 50%, and now they can't retire anymore. Or if people are retired, it puts them into a really bad situation, where if they keep spending like they normally would, they got a good chance of running out of money. So important to protect from those things, because people have short memories, right? when they come to the markets. When the markets are going down, people always think it's going to be going down, and when the markets are going up, people think it's always going to go up. And we've been on such a tear that people don't realize we've had, the last 10 years have been the best 10 years in stock market history, which is nuts, right? And it's higher
in the
stock market, right? We're in the best boom years ever.
So let's switch to Trump for a second and talk a little bit about his relationship with Fed Chair Jay Powell. He obviously wants to lower interest rates. Trump wants to see interest rates go down dramatically. Is it just me, or does the wishes of President Trump to drop interest rates like that seem like a really bad idea? What do you think?
Well, I think that interest rates dropping is going to be good for people who are trying to buy a home, right? The price of everything really has doubled in just the last few years. So people starting out and trying to get into a home makes it super difficult with where the interest rates are right now. And Jerome Powell doesn't seem to be too affected by anything that Trump says. He has stayed the course and pretty much ignored Trump pretty as much as he can, right, for the last year. He's been riding him pretty hard. But I think Powell's going to stay the course. I think they'll probably still continue to drop rates a couple of times this year. We'll see the long-term trajectory of that if they keep dropping the rates down. But it'll be interesting for sure. And we're definitely going to start seeing some inflation from the tariffs. And it's going to be interesting to see how all that shakes out.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. Talking to Patrick Mueller about the economy, about the markets. And, Patrick, I'm sure you're seeing this too, seeing a little bit of an increase in prices, maybe especially at the grocery store, maybe at restaurants. What is your forecast when it comes to inflation over the next 12 months?
I think it's going to be much higher than people anticipate happening. I bet we see, somewhere between a 5 and 10% bump, I would think, with the tariffs that are going to be coming in. And I don't understand how people are staying afloat as good as they are. And because it seems like, Bob, not that long ago that I was spending $100 and filling up the trunk of my car with groceries. Now it's seriously like 2 bags I'm walking out with. I'm spending $100. So we got 4 dogs. One big bag of dog food pretty much knocks out $100 these days.
Expensive.
But I see that going up, and people are starting to refi their 2 and 3% mortgages right now for 6-7+% mortgages because they need the money. They're struggling. You've got consumer debt at all-time highs. You've got companies like DoorDash who are now financing food purchases, where people are needing to finance their fast food, and it's like, what the heck? So people are really struggling more than the media is letting on that people are struggling.
Yeah, you mentioned mortgages a second ago, and in Texas, in Dallas-Fort Worth area specifically, we're starting to see a lot of supply in the real estate markets, a lot of homes that are for sale and they're kind of sitting there. And of course, the cost of mortgages is really putting a damper on demand. How long do you see this lasting? Are we going to get this? Are we going to go through something painful, or do you think we're going to fall into some recovery here?
I think we're going to go through more pain in the near future, but before things start recovering, because you got the commercial markets that are starting to take a hit. All these different companies that everybody's starting to work remote now. They've got all these buildings and all these spaces that they've got balloon payments that are starting to come up. You're starting to see the commercial market starting to get hit, and I think we're going to start seeing the housing market get hit. I think you're going to start seeing a lot more foreclosures coming up because people are, again, refinancing their debt, and when they can't refinance any higher, the markets aren't growing enough in the real estate market, right, to be able to be taking cash out of the homes. Then when that bubble bursts there, I think we're going to see the housing market come down before we start seeing it recover and start getting better.
Now, you mentioned something really interesting that I was hearing a lot about maybe 18 months ago, but I haven't really heard that much about this year, and that is the commercial market, and of course the leverage situation in the commercial market is horrible. Are you where you're at? I think you said, are you in Georgia?
Yeah, we're in just northern part of Atlanta.
Okay, Georgia. Atlanta. Are y'all seeing a lot of problems in the commercial space? I just have not seen that much in Dallas, and I thought we would.
You're not seeing it a lot in smaller businesses, small business, shopping malls and places like that. But your big high-rise buildings in Atlanta, you're having an issue. We've had some big foreclosures going on here in Atlanta. So we're starting to see the big massive business buildings. We're starting to see those taking on the foreclosures now first.
So what are your thoughts about the economy for the next year? Do you think we get dangerously close to stagflation, or maybe we dodge a bullet? What are your thoughts on it?
Yeah, it's going to be interesting. I think the economy is pretty strong. I think the economy is strong right now. I think we're going to be in for some volatility here in the near future. I would say within the next 6-8 months, I think we're going to be in for some volatility. But long term, I think that everything that's going on with the country right now and all the changes that are happening with the current administration, with regulations being pro-oil, pro-energy, pro-making stuff again in the country and being able to sell into other countries, I think long term, I think it's going to be really good. I think it's going to be like a rocket taking off when things start turning around here. But in the short term, like the next 6-8 months, I'd expect some volatility in the markets, and we could see a downside of, I think, 20 or 30% in the next 6 to 8 months.
Yeah, I call it detoxing, and we could use a good detox, I think, in the markets and the economy. Now let's talk a little bit about credit cards, because this was in your notes, and I definitely wanted to hit this. Through the years, I have experts come on the program that are in that space. They talk about what's happening. And it's funny because when I prep for these interviews, I'm ready to really talk about some of these issues. And like you say in your notes, nobody sees any issues. And I'm thinking to myself, you can't go on accumulating this amount of credit card debt at these interest rates and everything be okay. I think we're going to have a massive default at some point where people are just going to say, "To heck with this, I can't do it." What, I mean, talk a little bit about that.
I think a lot of this is coming, Bob, from the pandemic, and when everybody was locked down, and everybody went on such a spending spree over that period of time. You know, people moving into the homes that they really wanted to, getting pools, getting every fun, you know, activity vehicle that's out there, whether it's like jet skis or boats or whatever it might be. And then I think we're starting to see like a lot of the fruition of that. People just kind of went on a tear. And so now we're at all-time credit card debts, and seriously, with interest rates that are, you know, 20+%, it's crazy. Like, how are these people going to be paying these things down? And then I think that the craziest thing, you know, beyond the credit card debt and people financing their food purchases, and people are combating inflation with debt, and then people, you know, refinancing their 2 and 3% mortgages, which it sounds like a dream, right? If you could get a 2 or 3% mortgage right now, getting that rate. I mean, it sounds, you know, like a dream with where they're at now at 6, 7, 8%. And it's like people are refinancing that and taking their money out and refinancing it into that 6, 7, 8% rates. Or people are taking out home equity lines for, you know, 8, 9, 10%. So when people start piling up debt like that, and then they're refining their debt, and, you know, taking 2% money out and to refinance it to 6, 7, 8+%, there's going to be a point in time where they're not going to be able to pay that either. So, when that happens, I mean, that bubble's got to pop.
Yeah, I totally agree. I mean, I think there is a kind of an underground reality economy that's going on that nobody's even talking about. And, you know, what just troubles me is if we have all the politicians in Washington can't do something about these 25 and 30% interest rates on credit cards. I'm always amazed that credit card companies get away with that.
Well, so, you know, credit card companies, pharmaceutical companies, all these different companies, like all these politicians, when they get reelected, they get reelected by getting money from all these companies, and they're like, well, you know, do this or that. And so nothing, unfortunately, you know, the way our political system is and where they get their money from, I don't think that's ever going to change. They're always going to be able to pay off these politicians to do what they want. And that's why they don't like Trump in office, because Trump doesn't care.
This is Bob Brooks. Oh, go ahead. I'm sorry, Patrick.
No, you're fine. You're fine.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Patrick, I did not look up your website before I got on air. Can you tell us what your website is?
Yeah, the name of our company is Bella Advisors, and you can go to bellaadvisors.com.
Okay, thank you for that. Let's talk, saving the best for last, let's talk tariffs, kind of where we stand. You know, one of the interesting stories is it does not seem to be getting a lot of media attention is the fact that on November 4th, the Supreme Court is either going to rule or start taking arguments on this the ability to discuss the ability of President Trump to go out and place these tariffs because he wants to. Doesn't have to have congressional approval. What do you think the chances are of the Supreme Court coming back and saying, you know, you need to get Congress involved in all these, or you need to get the money back? I mean, I've heard that as a possibility.
Well, back in the 1800s, most of the money that came into the country was from tariffs. And for them to then change that, I would think it would be really tough. I think it'd be really tough for the Supreme Court to go back and change that, because it's also had a pretty good impact of how much money it's been bringing into the country. And they've been pretty, you know, so the other challenges that have happened this year when it came to Trump and trying to stop his agenda and the things that were happening, they have been pretty much pro-Trump and siding with Trump the majority of the time. So I would bet that it's probably going to stay that way. It's just, you know, one of those roadblocks and delay tactics that's happening from the Democratic Party right now that it's just kind of slowing everything up. So I would bet that they don't end up changing that.
Can you imagine what that would do to the markets?
Oh, yeah, it's absolutely bananas.
Yeah, that would not be good. Let's talk a little bit about some investment ideas. How do you feel about gold? I mean, is it too late to get on board? That has just been unbelievable to watch the price of gold go up that high. When I believe, I don't know if you think the same way, but I have my philosophy is that people are investing gold into gold for maybe some of the wrong reasons.
Yeah, well, it's definitely, there's a lot of hype. Anytime everybody gets excited about it, and you got the person next to you in the line at Starbucks talking about buying gold, it's probably the time to start thinking differently about buying into it. But gold is so fear-driven that when people are scared and the dollar's dropping and people are fearful and there's a lot of uncertainty, then people start putting their money into gold. Probably gold and shotguns and canned goods and all of that stuff. I bet is probably doing really well. But when it comes to gold, and then also silver's a really good one. Silver's been on a tear, and I think any of those precious metals, it's a safe haven for people when things are getting tough, and something that people have a tangible asset that they can actually get their hands on. So I think we're going to continue to see it going up until we start seeing the more clarity in the future as to where the markets are going to go, where the administration is going to go. There's so much fogginess right now about what the future is going to look like in the markets and the country, and the unrest around the world and all of this. I think we'll continue to see it climbing until we reach that point. But then we're good. But then we'll definitely see a pullback once the sun comes out and people start feeling a lot more comfortable about the trajectory of the country and what's happening. Then you'll start seeing money moving out of gold.
You brought up in your notes, you had something written down about utilities, and that is a very interesting trade right there. Of course, you definitely call that an AI trade. Talk a little bit about that.
Yeah, so here in Atlanta, this is like the Silicon Valley of the South over here. We've got just a ton of tech companies that are here in Atlanta. So there's these big infrastructure centers and data centers that are just popping up everywhere, and there's such a demand for energy when it comes to that. And you're seeing that more and more all over the country with these huge, massive data centers being developed, that there's got to be the energy to power that. When it comes to the utilities for all these companies, I mean, just the folks next door, we're really lucky. We've got a data center right next to us, and we actually get our internet feed directly from. We got super fast internet here, but they've got to power these things, and that's not slowing down. That's going to be such a big trajectory in the tech sector, and moving forward, it's just going to get exponentially bigger. And there's so much demand for it right now that's a really good sector to be taking a look at. And utilities tend to be pretty stable anyways, and so it's a good place for stable money. And I think we're going to continue to see that moving forward if you can find companies that are specializing in that.
One more time, Patrick, what is your website?
BellaAdvisors.com.
Great. Hey, Patrick, great to have you on the program. Good luck to you.
Thank you so much, Bob. Great to be with you.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. I do appreciate it. I'll tell you, it is interesting times that we live in. And I was thinking about all of the underlying storylines that goes on, and all the moving parts, and the possible inflation and the possible stagflation when we have a recession and inflation. And it always comes back to one thing for me, and that is know your risk level and be comfortable with it. If you feel like you're taking too much risk, dial that risk down on your investments to make sure that you're not taking too much risk. That here's the problem when people take too much risk, or they're out of their risk zone, so to speak, is that you start to make emotional decisions, and that's where some of the biggest mistakes are made when it comes to investing. Is to decide with your emotions as your filter. Now, if you're comfortable with your risk level, you won't do that. You'll be tempted to, obviously, but you're less likely to do that because you're confident as to where you are. So keep that in mind as you hear all the possibilities and all the information that's floating around about, about credit card debt, about gold, and you name it. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.